Hi folks, and welcome back to Meaningful Money. Right, I'm still here in my field in St Hilary on a chilly Sunday afternoon, but you find a good spot, you just got to make the most of it. Little itchy nose thing there, sorry about that. I'll imagine that'll continue now for this entire video, but I shall try to resist. Right, carrying on talking about mortgages, and we talked about repayment versus interest only last time, an important distinction you need to know about. And this time I'm going to talk about the different ways that the interest rate payable on your mortgage, which means your monthly payment, how that can change depending on what options you choose when you take out your mortgage. So before we get into that, my good friends down here in the bottom right, once again I need to thank, because Seven Investment Management sponsor Meaningful Money and continue to do so. Nearly a year now they've been sponsoring me, and I'm extremely grateful to them for doing so. So we talked about how you pay your mortgage off, repayment versus interest only. I told you about the nose thing. Now let's look at the way your monthly payments can change. So I'm going to nip back up into the corner again and bring in a graphic. So we've got this similar sort of graph as we had last time. So we've got the amount of your monthly payment on the left axis, the vertical one, and then time on the bottom axis. I keep saying access, one of those annoying Freudian slips that I just can't get rid of. Never mind. So the bog standard sort of default option is called the variable rate mortgage. And your payment will change depending on what the interest rate does. So if the interest rate goes up, your monthly payment will go up. If the interest rate goes down, your monthly payment will go down. Straightforward enough, right? It'll only change 1 month at a time. It won't change sort of mid-month. They'll just say, from your next payment, the interest rate will go up to X% or whatever, and your monthly payment will be X pounds. So that's all straightforward enough. It's worth bringing in something called a discounted mortgage next, and you'll see from the line here that it behaves almost identically to a variable rate mortgage, but the payment is less, and that's why it's called a discount. So you effectively get a discount off the variable rate for a while. You arrange how long that's going to be up front. It's going to be 2, 3, 5 years, sometimes even longer. And that's a great way of keeping your mortgage costs down at the start of a mortgage. But at the end of that term, however long you arrange the discount for, the payment then will jump up and join the standard variable rate. So it keeps payments affordable in the short term, and you get the benefit of it still if mortgage and interest rates go down. So that's the standard variable rate and the discounted rate. Now, here's a different alternative, something called a fixed rate. As the name suggests, you fix your interest rate for a period of time, 3, 4, 5, 2 years, whatever, again. Usually it sits slightly higher than the standard variable rate, but not always. And it stays exactly the same. So this is wonderful for ease of budgeting. You know exactly what your mortgage payment is going to be for 5 years, say. But again, at the end of that term, the payment rejoins the standard variable rate at whatever it is at that point. So, great in the early years, you know exactly where you are. The downside, of course, is that you don't get any benefits if the interest rate goes down. So you can end up paying over the odds. If interest rates go up, though, you're paying under the odds, which is fantastic. So there's a bit of risk there, depending on which way you think interest rates are going to move. If you think they're going to go down, you wouldn't take out a fixed interest rate mortgage. And the final one to say is a capped rate mortgage. Increasingly rare these, but worth just mentioning. And again, as the name suggests, it's almost like somebody thought these names through, really. As the name suggests, a capped rate mortgage puts a cap, a ceiling on the amount of interest that can be applied to your mortgage, and therefore a maximum monthly payment. So if interest rates stay below that ceiling, then they are variable, and you get the benefit if it goes down. But if interest rates are going up, they won't go through the ceiling, and so it's an element of protection, and again, ease of budgeting, because you know what your maximum payment is going to be. Okay, so those are the sort of 4 main types of interest rate behaviour. So I'm going to leave it there actually, and probably talk about offsetting next time. Useful little trick when it comes to mortgages, depending on your financial situation. But hope that's helpful in explaining those main ways that the interest rates move. So I'm going to move on from here now. I've done 3 videos here in St Hilary, and it's freezing, so I'm going to go in and have a hot chocolate or something. So thank you very much for watching, and I'll see you next time.